The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Autumn and I'll be your moderator for today's webinar on multi-channel selling and your sales tax obligations. Our presenters today are Jeff Meggs and Brian Greer. Before we get started, I wanted to go through some housekeeping items and do some technical checks to make sure everything is working. First, if y'all don't mind going to the questions tab on your control panel and letting me know that you can hear my voice and see the slides. Feel free to also let me know where you're calling in from. I do enjoy reading those. And if you have any technical issues, please let me know in that questions tab and I'll do my best to get to you as quickly as I can. This is also where you can put your questions and comments for the presenters. And I already see a lot of people chiming in. Welcome. We have Long Island, Texas, Florida, Delaware is here, Chicago, Colorado, you're out here with me, in Gulfport, Mississippi. All right. Thank you for letting me know that everything is working. This webinar qualifies for 1 CPE credit. You earn that credit by staying logged in for 50 minutes and answering the poll questions. We'll have 4 polls, and to earn full credit, you need to answer at least 3 of them. I wanted to let you know that we're recording today's webinar, and the archive along with your credit will be available in your CPA Academy account within 24 hours. And if you have to log out and log back in for any reason, the webinar software will keep track of your time. We also recommend that you download today's presentation materials, which can be found in the Control Panel's Handouts tab. Now that we're all set, let's welcome our first presenter. Brian, the floor is all yours.
Hey, thank you, Autumn. Appreciate that. Yeah, as Autumn mentioned, I'm Brian Greer, joined here by one of my partners, Jeff. The sales tax for a long time. Every time we do one of these, it gets longer in terms of our time together, but it's been over 20 years that we've worked together in the sales and use tax space. Just to kind of give you a little bit of background on ourselves and our firm, if you're not familiar with Tax Connects, we kind of specialize in this sales and use tax area, tend to really focus in 2 different practice areas within our business. One is the consulting advisory type of practice line. Jeff heads that up for us. And we help companies quite frequently identify sales tax nexus issues where they have taxable sales, where they have sales tax exposure, kind of project-oriented work like that. And then we also have a compliance outsourcing service where we act as an outsourced sales tax department for our clients, where we prepare and file sales tax returns, remit the payments, and kind of manage that administrative process for them. So that's kind of the quick commercial on Tax Connects. Myself, I've been in sales and use tax since about 2000, so I guess going on 23 years. Jeff, really since the early 90s, right?
August of 1990.
So that's 30 plus years for you. Congratulations. But Jeff brings a lot of good experience from a industry perspective, also working as a consultant. He's had different sales tax responsibilities at some of the big 4 accounting firms. And as I mentioned, he and I have worked together either at Tax Connects or Thomson Reuters and our predecessor for about 20 years or so. Real quick on the agenda, the overall topic, as Autumn had mentioned, is the multi-channel selling. And we kind of break these out into really 3 primary categories, that being the kind of the direct or the retail sales, wholesale selling, and then the marketplace facilitators. And that's kind of introduced some nuances and challenges for a lot of companies recently. But as we talk about those kind of 3 primary channels, there's some underpinnings that I think are important to understand, regardless of what sales channel or multiple channels we're selling through, that being nexus and the taxability of our revenue stream. So we'll kind of start the presentation with kind of a quick overview of nexus, both from a physical presence as well as an economic presence perspective, and talk about taxability a little bit before we really kind of drill down into these additional sales channels, as we're referring to them. Please throw questions at us. We'll address them during the presentation. Hopefully we'll have some at the end as well. We'll definitely have some time at the end to address them if we don't get to them during the presentation. So before we get started, we've got the first polling question. Autumn, I'll let you pull that up.
Sure. Poll number 1 is live on your screen. As a reminder, we'll have 4 during the presentation. You need to answer at least 3 of them to earn full credit. I'll leave each open for a minute to make sure everyone has an opportunity to vote.
So Jeff, I'll put you on the spot here while that polling question is open. Maybe just a quick 30, 45-second background on yourself before we get going. I kind of gave a quick overview, but
well, first of all, I think we all felt there's a lot of compassion in our relationship and how you described how long we've been working together. It sounds like you're eager to go another 20 years. Yeah, as Brian said, I've got a little bit of diversity in the last 33 years. I started as an auditor with the state of North Carolina in the early 1990s, effectively August of 1990. And then about 4 years into that, I had an opportunity to join Ernst & Young and start their sales and use tax practice in the Carolinas out of Charlotte. Spent about 3 years there and then had an opportunity to get into industry with General Electric. And there I led a team of about 15 people, each of which had a different GE business across the country for which they were responsible for providing general sales and use tax consulting support for them. Came back into public with KPMG, and that's kind of where our lives intersected here with Brian and I. At KPMG, I came into the Atlanta practice. We were facilitating a formal relationship with a company called Tax Partners, our prior company, and I kind of facilitated the relationship from the KPMG side. What's interesting about that is it's come full circle, and now the current KPMG outsourcing business is our old business. I eventually was asked to come in and head up operations for Tax Partners, and that's where I got to meet Brian and work with Brian and our managing partner, Robert Dumas. So that was kind of I think it was in 2003. So it's right at 20 years.
Perfect. And I think, Autumn, we saw that it looks like from the polling results, most of the audience is involved in direct retail or e-commerce sales. Probably didn't give an option there in terms of all the above, because I'm sure there's some participants that sell through all of those different channels, but appreciate you pulling that up. So we'll jump in here with the Nexus discussion, and I'll let Jeff take this piece.
Yeah, we always like to start with this because it's the critical piece. You know, it's the link. Nexus is really a connection with a jurisdiction that allows that jurisdiction to impose its taxing authority on a company or a person. Traditionally and historically, when we talk about sales tax nexus, we were referring to a physical presence. This goes all the way back to some court cases in National Bellis Hess versus the state of Illinois in 1967, where the court started to really put good guardrails up for companies to follow relative to what constituted physical presence. In that particular case, National Bellis Hess was a clothier. They sold clothes through catalogs. They would ship catalogs to customers, prospective customers, I should say, in the state of Illinois. Those customers would call or submit a order form through the mail, buy some clothing, and Illinois set out to impose their sales tax on those transactions, citing that the catalogs represented a physical presence for National Bellis Hess. That went up to the courts, and the courts started to really give us good definition. They did rule in favor of National Bellis Hess, and in doing so, they really talked about or stipulated some of the key elements of what would be considered a physical presence. Those being obviously things like an employee, an office, a physical location within the state. I think we can all relate to those. Having inventory in the state, maybe in a third-party warehouse would also be a nexus creating activity. And then traveling into the state, traveling sales reps that are periodically visiting the state, soliciting on behalf of the retailer, tends to drive nexus for sales and use tax purposes. Similarly, if you're attending a trade show, you're likely there to promote the wares of the services of the business, and as a result, you're soliciting, essentially. There are some states with some really unique rules around trade show activities and attendance. So there's some thresholds that are in place in some of those states. But it should be considered a nexus creating activity. Lastly, one that doesn't necessarily resonate with everybody until they're identified for audit is engaging third-party contractors to perform services. Brian and I were speaking in Dallas a couple of years back, and as we were getting ready to start our discussion, a gentleman walked up to Brian and I and just had a casual conversation and described his business. And his business was very successful, based there in Dallas, didn't have any locations or employees in any other states. And what they were doing was installing those, I guess you'd call them card readers, at the doors of hotel rooms that we all use to gain entrance to our rooms these days. They were selling them all over the United States, but what he did was engage third-party contractors to install them. And he was of the opinion or perspective that because he had no employees there and had no other inventory or physical presence, that he didn't have nexus. And it was surprising to him when we explained that the engaging of those third-party contractors was indeed going to give him a physical presence. So that's sort of where we stood for a good, 50 years or so, until the South Dakota Department of Revenue decided to formally enact and legislate an economic nexus standard. So in doing so, basically they set in place thresholds, either $100,000 in gross receipts derived from sales into the state, or 200 or more transactions within a given calendar year within the state. Either of those were deemed to be nexus creating activities at the time that legislation was introduced. That legislation also had put in place some really efficient and effective ways for there to be some challenges to the law, so that it would go up through the courts in an efficient manner, so that everybody wouldn't be left hanging, wondering whether or not this was really legal. And eventually, South Dakota identified Wayfair. Wayfair is probably familiar to many of you. It's an online retailer, home goods. Identified and asserted nexus for Wayfair for sales tax purposes. Wayfair fought the assessment and the assertion, went up through the South Dakota Supreme Court, and interestingly, the Supreme Court of South Dakota ruled in favor of Wayfair. It said it was unconstitutional. The state of South Dakota took it to the federal level. U.S. Supreme Court decided to hear the case in April of 2018. And in June of 2018, the U.S. Supreme Court, a little bit surprisingly, came down in favor of South Dakota 5-4. And in doing so, opened the floodgates for all the states to enact their own legislation. And they did that. They did it at different degrees of expediency. Some of the states were they had already written their legislation. They had it in their back pocket and they were ready to roll it out. So a lot of them did start really early, July of 2018, October of 2018. A number of states had sort of gone live with their legislation. But over the next couple of years, all the other states kind of came in line with that sort of philosophy. And each of them, while they established what I would consider a relatively similar threshold, they are all or potentially different. Maybe not all of them are different. A lot of them are the same. Most of them you will find use a $100,000 threshold. And basically that's gross receipts derived from that state through invoicing to that state during a calendar or a 12-month period. Effective January 1, 2023 was the last state to go live, and that was Missouri. Missouri had enacted their legislation a year or so before, but it didn't go live until January. So today, all 45 states plus DC, that these are the states that impose the sales tax, do have an economic nexus standard. But while I do believe it's important to kind of think of it as a $100,000 threshold, you should note that there are states with different thresholds. California, Texas are 500,000. Mississippi and Alabama are 250,000. And then there are a number of states that still have that 200 transaction threshold that can creep up on you a little bit. Interestingly, I believe I've read that South Dakota is going to repeal their 200 transaction threshold very soon. A number of states have done that. They initially had a 200 transaction threshold and have since repealed that piece of legislation. You'll also note that while there are 5 states that don't have a state level sales tax, those being Alaska, Delaware, New Hampshire, Montana, and Oregon, the state of Alaska, the cities within the state do have some sales taxes that they self-administer. So those cities have kind of formed a coalition and have instituted their own economic nexus standard for similar thresholds. $100,000 of sales into the state of Alaska would it give you nexus in those cities, and you'd have to start to comply with those city level sales taxes.
I'll let Jeff catch his breath here for just a minute, and I'll add one other comment here from a nexus perspective that we've seen, and this may be of particular interest to any of you that are selling through an e-commerce channel, for example. What we saw over a period of time was that companies that sold through Amazon, for example, and we'll talk about this a little bit more in the marketplace facilitator piece, but just in general, companies that would send inventory or send goods to a company like Amazon, and then contract with Amazon for the sale and distribution of those goods. What would happen is Amazon would move that inventory into various warehouses across the country, and a small e-commerce provider could very quickly establish a physical presence through that inventory throughout the country. And we've seen at least one state, Pennsylvania, earlier this year, has specifically ruled that if you're not in control of that inventory and that inventory winds up in a Amazon warehouse, for example, in their state, but you didn't direct it to go to that particular warehouse or to go into that particular state, Pennsylvania is now not considering that a physical presence or a sales tax nexus creating activity. So newer legislation earlier this year, likely to see more of that come as additional states tend to follow the lead of other states.
Yeah, and you know, the other thing is, depending on which side of the fence you stand, sometimes that Wayfair decision seems harsh and impractical and complicated. But there are some scenarios where it's actually been helpful. And what I mean by that is it does at least sort of give us a sense for what is material. $100,000 is a good number. It makes sense. I know that's a fairly small number for most, but in comparison to some of the other standards that we talked about from a physical presence test, we would have clients that would say, hey, I had an employee fly into the state and spent one day. Do they have nexus? And the reality was that the states weren't very clear on whether or not that created nexus. Some were clearer than others, but a lot of them were ambiguous as to the frequency of those activities in a given year or a given 12-month period. So at a minimum, we get with these thresholds some bright line tests, and that can be helpful to larger businesses or businesses that are accelerating in growth quickly and also have some of that traveling sales rep type activity. It gives them sort of a challenge to avoid tracking the number of days of activity and focus more on the revenue. But I'll leave you with the fact that both the physical presence and the economic standards are still alive and in play. So you can have one or the other, or both. So once we get to the place where we've identified where nexus exists, where do we have an obligation to comply for sales tax? We then look at whether or not our products or services are taxable. Taxability varies by state, similar to the nexus rules, and sometimes the same services we've been delivering for the last 10 years in the state of California, for example, all of a sudden we're selling into the state of Pennsylvania and it's taxable in the state of Pennsylvania. So it's important to understand your products and service offerings from a taxability perspective. But the reason we start with Nexus is there's no reason to investigate until you have Nexus. And it's at that point that you want to give that some consideration. Generally, all of the states that I described that have a state sales tax, they are starting with the taxability of tangible personal property. That's generally taxable in any case on a retail sale basis. Services, they're widely, I think the majority of the population believes that services are generally not subject to sales tax. That's not the reality, but it is true that a great portion of services do not get taxed for sales and use tax purposes. And then the other thing that's important to understand and to build into any process you might have for a sales and use tax implication would be situsing. Where does the sales tax apply? If I am in California and I'm remotely providing some sort of taxable service to a customer in Pennsylvania, but again, I'm doing it remotely, where is the tax situs? Is it in California where I'm actually physically located at the time I perform that service? Or is it Pennsylvania where the customer is receiving the benefit? And generally speaking, across the board, you can count on it being the benefit of service. Where is the benefit of service received by the customer? That generally is going to be the situs for sales tax application. So now we kind of just have a framework of Nexus and taxability. We'll get into the channels, direct sales being the most common and understood, I think, amongst most of us. If you're direct sales, you can be doing that through the internet. You can be doing it at a storefront. The same sort of general philosophy or logic applies. First, we have to identify and determine whether we have Nexus. Second, we have to determine whether or not the products and services are subject to tax in that particular state. And then we have to build within that process rules that govern the situsing. Now, it can get even more complex when you're operating in multiple states with multiple storefronts, because in some states you can be operating in a point of origin state, meaning if you ship it from one county in the state to another county in the state expects you to apply the tax on the origin of that transaction, the storefront. In other states, if you sell to a customer and deliver it to them in another county in the same state, they will dictate that's a destination-based tax. So for the local tax portion in those transactions, it could be a different tax treatment depending on the state, depending on the type of business. But most of us look at these activities today in a more multi-state fashion and an e-commerce environment where the shipments are typically originating in the course of commerce outside the state. And in that case, we would just always apply a destination situsing rule, ship to location. Whatever the invoice says the customer's in receipt of the transaction is where the tax situs will be. That's the rate that will apply. And then lastly, you've got to be in a position to calculate the tax effectively and track it back to the GL and ultimately report it on the return. So I'm going to let Brian talk a little bit about setting up a tax calculation process, which is the meat of making tax work anyway.
Yeah, this will be a 2 to 4 minute description of something that can take 6 to 12 months to actually set up and implement. And as you can imagine, it varies from client to client. But as we're working with companies and we start to talk about Nexus and taxable sales and even some type of exposure, there's often a parallel path at the same time where we're talking about at some point you've got to be in a position to apply this tax correctly. A lot of the companies we work with, they might be working in a single state initially, and now they find out that, hey, we're in 10 states or 15 states or 20 states. What do we do? How do we manage this? And there's a lot of factors that go into making that decision, including the number of invoices that a company sends each month, the number of states that they're operating in, the complexity of the taxability of their products and services, And as I describe that, you can potentially imagine a scenario where someone is sending 5 or 6 or 10 invoices a month. Maybe they're very, very large transactions, and the taxability is relatively simple. You don't need a lot of sophistication to be able to manage the application of sales tax in that scenario. You can also have situations where maybe you are in a multi-state environment and you're selling software as a service, or you're selling telecommunication services, or something that has very complex tax treatment that even in one state could be very difficult to manage as you start to look at the individual state and local and district tax rates that may apply. So there's this spectrum of complexity that you have to really understand how many states and how many invoices and what's the complexity of the tax application here to decide what is the best way to do this. And we have a lot of clients that use their standard accounting system, their QuickBooks or NetSuite or whatever the case may be, where there's some fairly basic rudimentary capabilities to manage sales tax within those solutions, and they may work very well. There are even e-commerce platforms. A lot of companies utilize Shopify. There's some sales tax capabilities built into the Shopify platform that, again, depending on the complexity of your scenario, might work very, very well. There are other scenarios where maybe it is a pretty complicated sales tax application scenario. You've got hundreds or thousands of invoices all across the country. In those situations, we start to look at some type of sales tax technology to help automate the application of the tax on that invoice or even within the shopping cart. A lot of the audience is probably familiar with many of those plug-in options or those options that integrate to the accounting system, like an Avalara, for example, or Thomson Reuters OneSource, SureTax, Vertex, TaxJar. That's 5 of probably 8 or 10 that tend to dominate the marketplace. But all of those would integrate with the shopping cart or the e-commerce system, or the accounting system to determine and calculate the sales tax in real time. Again, just looking at the complexity of your scenario, whether you would have to implement one of those types of solutions or not. We also see kind of hybrid scenarios where on one end we're leveraging third-party software, sales tax calc software. On the other end of that spectrum, we're utilizing the native capabilities within the accounting or e-commerce solution. There's kind of an in-between zone there too, where someone might leverage just a tax rate application service. So they're selling tangible personal property. They know it's taxable everywhere. All they need is a current tax rate in a particular jurisdiction. And that's a easier equation to solve for versus the more complex taxability determination plus the application of the sales tax. So we see all of those different flavors that come into play there. So I think with that, Autumn, I think we come to the second polling question. Actually just had an audience member ask if we had any polling questions. This is the second one that Autumn's getting ready to pull up.
Yes, poll number 2 is live on your screen.
We often just like to get a better feel for, the audience in terms of, are you mostly concerned about nexus rules, taxability rules being audited? So perhaps that can help guide some of our discussion here as we continue going. There was one question from the audience, and I'll ask Sarah to maybe clarify what she's asking in terms of what is step 3. I'm sure at some point myself or Jeff had referenced multiple steps in maybe determining sales tax responsibilities, but if you could clarify that question for us, that would be excellent.
Yeah, I probably created that question from something I said earlier. I kind of referred to determining nexus as step one, determining taxability as step two, and I think the process, building the process, the calculation methodology, as well as the back end reporting and payment process is probably what you consider step three.
Kind of the third step. Yeah, makes sense. And so I think the audience can see the results there, but fairly typical in terms of most of the concerns lie with keeping up with Nexus rules and where my company has Nexus, and then also understanding the taxability of their products and services. So I think that brings us to the wholesale piece here, Jeff.
Yeah, so when we're talking about direct sales, what we're really talking about is a retail sale transaction, meaning we're selling to the end user consumer. And that typically is where the instance of sales tax should apply, is when the transaction involves an end user consumer. So when we kind of flow over to wholesale, there's a tendency to think, well, it must get easier in wholesale, because in wholesale, what we're talking about is selling to someone who in turn is going to resell the product, maybe to an end user, maybe to another wholesaler. But in any case, we generally would theorize that a wholesale transaction is not a sale to an end user consumer. However, as we'll see as we talk through this, it's not quite that simple. In fact, I would argue that it's probably even more difficult in some cases for wholesalers to maintain a high degree of confidence in their compliance process than a direct retail seller. So let's talk about some of the reasons for that. Again, if it's a wholesale sale, there is a reason for that. It's usually because the customer is going to resell that product. And in doing so, they would have to be registered and in a capacity that they could issue a resale exemption certificate. So if I'm selling tangible personal property and a customer wishes to buy from me and exempt that transaction for tax, assuming I, as the wholesaler, have nexus in that jurisdiction, I will have to get or obtain that exemption certificate. Otherwise, the state will require me to charge tax to that customer. So in the absence of a form or documentation of some sort proving the exempt status of that customer, it's a taxable event. When we talk about some of the service elements that we described earlier, and services in a wholesaler's world probably looks more like shipping charges, more like maybe some installation things that might be happening. But if we back up a little bit, there are services that are resold. Software as a service is a common product that's resold today. So there's wholesale sales of services that take place across the country. When you're selling a service that is subject to tax in the jurisdiction in which the transaction is going to be sitused, you still have to get the exemption certificate. You still have to get that documentation. However, if you're selling a service into a state that service is exempt, we call that an exclusion, meaning the statutes don't apply sales tax to that type of transaction or that type of service, and as a result, you can sell it freely without charging tax and without having to obtain or procure any type of exemption documentation. When we talk about the exemption documentation, what's challenging for a lot of companies, and again, this is where wholesale can be even more complex, is that the form of exemption could come in any facet of document that you could imagine. It could be on letterhead of a customer. It could be a state prescribed form. It could be a state issued certificate. There are a whole host of unique jurisdictional certificates that exist out there for special circumstances. Sometimes when a mall is being built, there'll be some tax incentives afforded the contractors building that mall, and those contractors will get a special certificate that they can take to their vendors and exempt purchases under that specific exemption. So there's a whole host and maybe an unlimited number of ways that you might receive an exemption certificate. Generally, what we're looking for in terms of validating an exemption certificate is there a description of the business activities or a description of the product that's being purchased that makes sense relative to the company that's buying it. So you would need to have the company's name, company's address, you need to have a signature and a date, but you also need to have some substantive communication within that document that describes the product or service that's being sold. And the level of due diligence required on the part of the vendor can vary. It doesn't necessarily vary by state, it just varies by industry. There's basic logic that's really all the state's looking for when you're accepting exemption certificate, is that there's a basic sense of logic that it's an applicable exemption. Once you get an exemption form, you need to keep that exemption form and associate it with all the transactions that it applies to, and keep it for a period of time that extends beyond the general statute of limitations. And what I mean by that is, if you're registered, the general statute of limitations for sales tax purposes is usually 36 to 48 months, depending on the state. So you'd want to have that documentation retained for at least that long. It could be that you get the exemption certificate in 2018, and then you continue to sell based on that exemption certificate into 2023 and 2024. Well, you've got to keep that exemption certificate to support the exempt status of every single one of those invoices through the duration of that relationship. There are some of these exemption certificates that do expire. We recommend updating exemption certificates every 3 years. There are some states like Florida where they issue resale exemption certificates through their website to registered vendors, and you have to get it updated every year. It's done on January 1st of every year. There are other states that have other retention periods or validity periods that might go as many as 5 years. So pay attention when you get an exemption certificate, and then understand that roughly in the absence of any set defined period of expiration on the form, we would say be cautious and use a 3-year expiration. The other thing that makes wholesale business activities relatively complicated are drop shipments. A drop shipment is a 3-party transaction. Essentially, you have a wholesaler who's receiving an order for goods from a retailer, and that retailer is instructing that wholesaler to deliver those goods to a third-party address. Now, the wholesaler doesn't always know that it's a drop shipment. The wholesaler knows who they're selling to. They're invoicing to XYZ company, and we've got an example that we want to illustrate for you in this regard. So this first example is an Arkansas-based wholesaler who's selling to a South Carolina retailer. And essentially that retailer has a website. This is also common today. They don't maintain their own inventory. They simply place items for sale on their website, and then when an order comes in, they immediately place an order with a wholesaler or distributor who then can hold the inventory and make available that shipment to the customer on a real-time basis. So in this case, an Arkansas wholesaler is selling to a South Carolina retailer, but the South Carolina retailer has instructed shipment to be the state of Illinois. It happens that in this case, the Arkansas wholesaler has nexus for sales tax purposes in Illinois. So they would be obligated to either charge sales tax in Illinois on this shipment or collect and procure an exemption certificate. The rules are generally the same in a lot of states relative to these types of transactions, but we are going to talk about some exceptions to that in just a moment. But in Illinois, the state of Illinois is going to require an Illinois resale certificate for this transaction to be considered exempt. And if that state of South Carolina vendor or the retailer is not registered for sales tax purposes in Illinois, they will not have the capacity to issue a resale exemption certificate. What does that mean? the Arkansas wholesaler is going to charge Illinois sales tax on this invoice to the South Carolina retailer. And the South Carolina retailer, unless they're registered in Illinois, will have no other option but to pay that tax, and it will just eat up their margin, their profit margin.
And I think, Jeff, I'll just make a comment here. These drop shipment scenarios have become increasingly problematic for people. I think post Wayfair, as that wholesaler in this example or that distributor historically may never have had any physical presence in Illinois and never had any necessity to charge or collect the Illinois sales tax. Now, based on the economic nexus standards, they do have that obligation. So we see this as being much more problematic than it was probably 10 years ago.
That's exactly right. So let's talk about another scenario and add even more complexity to an already complex transaction. We're going to take the same wholesaler, we're going to use the same retailer, but the customer, the end user, is going to be located in Utah in this example. And when the wholesaler goes to the South Carolina retailer and says, I need an exemption certificate, in this particular case, because the shipment is going to Utah, Utah has a special rule that says if the South Carolina retailer or any retailer in any other state is drop shipping tangible personal property into our state, and that retailer does not have nexus, does not have an obligation to comply with the sales and use tax rules, that retailer can actually issue their home state exemption certificate to the wholesaler and exempt this transaction from Utah sales tax. So this is the exact same transaction we just talked about and illustrated in Illinois. And in Illinois, that option doesn't exist. Utah does afford the retailer that particular option. Now, the states vary a great deal on what kind of form, what kind of documentation is required, but there are a number of states that are like Utah. If the retailer does not have nexus, there will be potentially some other options. And what's challenging here is now we have two, I'll call them vendors. We got the wholesaler and the retailer, both of which have to be educated in the rules of Utah to be able to execute this with accuracy. And I can tell you from experience, it's rarely the case that both are in tune with that rule or those rules. When the retailer knows the rule, the wholesaler denies the exemption, declines to accept the exemption certificate because it doesn't make logical sense to them, and it's not an easy rule to find. And so there's usually some level of coordination that has to take place to explain and confirm the presence of these types of rules in different states. So there's some variability. I think we'd call it opportunity to a large extent for retailers to achieve that exempt transaction status for resale. But again, there's some relatively archaic rules that are not easily found to substantiate it.
So Autumn, I'll let you pull up the third polling question here for the audience.
Sure. Poll number 3 is live on your screen.
Excellent. And while the group reviews that and answers that, I'll relate back to an earlier polling question where I know Nexus and keeping up with Nexus activities was a big issue or a big concern for the audience. As Jeff was talking about this wholesale transaction scenario, one of the things that we have to keep in mind as we're kind of evaluating, tracking our sales tax nexus footprint is that the key word that Jeff described from an economic nexus perspective was gross sales, meaning all sales, including wholesale sales. Now, there are variations state to state, but if you do look at the individual states, I'd say roughly 35, 38, maybe even more consider gross sales as the unit of measure. And there's only a few states that will exclude the wholesale sales from your measure as to whether you've reached those economic nexus standards or not. So one question here from the audience as we finish up this polling question. Jeff, I'll pose this to you. It's from Josh. It's related to SaaS. And I think predominantly the citusing of it, but Josh says, I'm in-house and we've been growing our sales of SaaS products as well as SaaS purchases. Particularly with purchases, we've been finding it more and more difficult to correctly determine taxability and apply the tax using a multiple points of use methodology. Are there any resources that you would recommend for best practices on managing sales tax for SaaS? The loaded question.
It's a good question that we've heard from others. So I'll kind of try to answer your question and speak to a couple of novelties that are associated with it. You're clearly, Josh, already familiar with the MPU exemptions, multiple points of use exemptions. So what Josh is asking for those of us that aren't maybe SaaS trained or SaaS knowledgeable, software as a service is basically logging in to access a software platform and executing a various degree of transactions through that software. So it's no different than downloaded software in terms of what it can do for the customer. But instead of the customer hosting the software on their own laptop or their own servers, they're leveraging a cloud-based hosting service. So the vendor's hosting it on a platform or a server somewhere else. The other thing that's interesting about the SaaS product is when a SaaS subscription is sold, it can be sold with multiple seat licenses, maybe 100 or 1,000 seat licenses. And in today's economy, those seats are the people that are using the software, the login credentials. They could be located in multiple states and just about anywhere. So there has to be some equity in how those transactions are cited, such that if I'm selling SaaS to a customer in New York, let's say, and they have a 1,000-seat license, and New York does tax SaaS, so it is subject to sales tax, the inclination would be that that entire invoice would be taxable because it doesn't really have a ship to location, it just has an invoice to location at that point. What can happen, though, is the customer can realize that, hey, a lot of my users sit in states where SaaS isn't taxable. So instead of us just paying this New York sales tax on the entire amount, let's isolate those that are in New York from those that aren't in New York and are in other states where maybe the SaaS product isn't taxable. And in those cases, they can execute in a series of, it could be an email, it could be a letter to the vendor indicating that their users are located in these specific areas or locations. That tends to put the onus back on the vendor for deciding the situs and applying the tax. And at that point, the vendor might be in a position where they have to apply the tax to all the states where it's taxable and exempt all the states that aren't taxable on one single invoice. And so you end up with multiple lines of sales tax on a single invoice. For that reason, and in that example, we don't encourage vendors to seek out those exemptions or those circumstances, because the more you seek those out, the more confined you're going to be within the rules of all the different states, and you're going to have to be more creative and more sophisticated with your invoicing to capture all those different sales tax rules. So what some of the states have done, Texas, Massachusetts, Washington, is they've established MPU exemptions, multiple points of use exemptions. And with those exemption certificates, the customer is basically relinquishing the responsibility for sales tax from the vendor to themselves. So now the customer has to look within their own records and operations and accrue use tax on the SaaS product where it's applicable, where they have users, and in those states where it's taxable. That is an ideal scenario for any vendor to receive the MPU exemption. There are no other real tricks that I'm aware of to manage to that degree on the purchasing side. And again, back to my original sort of example, we encourage our clients not to seek out that opportunity to bifurcate an invoice amongst a bunch of states. It's usually very challenging for their billing systems. That didn't answer your question. I don't think it did answer your question, but maybe gave you a little perspective that I hear you. I think it is a challenge, but happy to talk with you offline if we need to. So I'm going to walk into the third channel and last channel for today's discussion, marketplace facilitators. Let's first talk about what is a marketplace facilitator. I think we all know what it looks like, but what it really entails is it's a platform or an environment where an organization can contract with third-party sellers. And it usually has to be an open platform whereby anyone can participate so that they can facilitate retail sales. Think of a flea market online. It's kind of the way it works out. You buy an opportunity to participate in that flea market, and you set up your stage for customers to come through and look at your products. But what's key about marketplace facilitator rules for sales tax purposes is that in addition to setting up the platform and the environment, there also has to be acceptance of payment or facilitation of payment. So a marketplace facilitator does both establish the marketplace environment or the platform on which multiple third-party retailers can sell their products and accept and process payments for those sales. Amazon, eBay, Etsy are examples of companies that fall into that category. There's other companies that we might look at and think that they are marketplace facilitators, but for the fact that they don't actually accept payment, you're routed to a different payment processing routine, and that pulls them out of that marketplace facilitator definition. What's interesting about marketplace facilitators is the result of Wayfair opened the doors for the states to sort of pull in marketplace facilitators into the economic nexus theory and require them to charge and collect sales tax on those sales that are facilitated by their platform. So the rules are very similar. They're dollar amount thresholds. A lot of them are the same thresholds. There are some that are a different threshold, but I just encourage all of my clients to think about $100,000 as the threshold. And if you are engaged in the capacity of a marketplace facilitator and you do have an excess of $100,000 in revenues in any given state, you better take a look at what's going on in your process, confirm whether or not you've established nexus. And if you have, you now have an obligation to calculate and collect sales tax, as well as report and remit that sales tax to the states in which you're operating. So what does that mean for the retailer who's participating and leveraging the marketplace facilitator platform? Well, it's a good thing in that the facilitator has the responsibility for charging and collecting tax. So for the most part, that remedies a large degree of headache that I otherwise might have had as a retailer. As Brian was describing the thresholds and the fact that we use gross receipts to establish a nexus threshold in most of the states, there are some states where they will exclude marketplace gross receipts. The vast majority of the states will require that you include marketplace gross receipts in your nexus equation calculation. So there are a few states where the actual returns themselves that you file require you to report the revenues that were driven through the marketplace facilitator, in addition to your own sales through your own platform, your own website, or your own brick and mortar location. So just some nuances that differentiate some of those different sales channels, and hopefully it gives you just a little perspective as to where sales tax intersects with some of those channels.
So Autumn, I think we have the last polling question here, and then I'll just remind the audience to please add any questions that you'd like for us to hit here in the next couple of minutes before we wrap up.
Sure. Our fourth and final poll is up and running. If you missed one for any reason, make sure to cast your vote here.
Thanks, Autumn. And just a couple of questions here from the audience. Jeff, I'll direct this first one to you. In terms of evaluating gross receipts, how do discounts factor into that? Is that part of a gross receipts, or is that excluded?
If the discount is within the invoice, then we would expect the discount would reduce that gross receipt for purposes of that calculation. If your gross receipts or your discounts are volume-based and they're implemented later in time, it's likely that you'll probably want to include them and maybe be required to include them in your gross receipts. I think it will depend on timing and the overarching sort of materiality of your overall sales. But discounts that are on an invoice or cash discounts, things of that nature, tend to be real-time calculations and reductions to the gross receipts.
Perfect. The last question that we'll get to here, and then I'll turn it back over to you, Autumn. This is more of a international question. So does international seller who does not have a physical presence in the U.S., do they need to comply with the Nexus rules? Are there any differences in the rules between international seller and local seller? I'll initially answer this, and I'll let Jeff kind of chime in as well. But it's interesting that we work with a lot of international businesses, and what's interesting is that they tend to have a much higher degree of wanting to comply with U.S. sales tax rules than domestic businesses do. Maybe more of the culture of a VAT type of program that they're used to, that they're used to the necessity of compliance, so they tend to want to comply more than U.S.-based businesses do. That being said, the rules still apply to international businesses. What we see, of course, as the question references, is that they don't have a physical presence typically, but they are subject to these economic nexus standards as well. So when they sell into states, they need to evaluate the number of transactions and/or the sales activities, the gross receipts into those states, and those economic and nexus standards still apply to the international seller. Then they would have to look at whether or not their product or service, their revenue stream, is subject to sales tax, and they are responsible for the collection of the applicable taxes, just as a U.S. business would be. So with that, Autumn, I know you've got a little bit of housekeeping to talk through here at the end. I'll turn it back over to you.
Great, thank you so much. A pleasure having you both with us today. Want to remind everyone that the handouts, the archive of the webinar, and your credit will be available in your CPA Academy account within 24 hours. And if you look in your email inbox, you will find the evaluation link for this webinar. All questions that were asked today will be forwarded in a full report to our presenters as well. And I see some great comments coming in. Thank you for those. And thanks again, Brian and Jeff, for your great content, and to our members for your participation. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thank you, everyone.